Hello, everyone, and welcome to our first quarter housing outlook. Today's focus is on the Midwest. I'm Allie Wolf, the Chief Economist with Zonda, and I'm joined today by Dan Fulton, Zonda's Senior Vice President of Advisory. As mentioned, we are with Zonda. Zonda is the largest new home construction data company in North America. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Our clients access our data through Enterprise, the complete data solution for home builders. We also have unique data products for different client types, including Building Product Pro and Mortgage Pro. Now, I run our economics department, which is our analysis arm. We take all the great data our research team collects and provide the so what in reports like National Outlook, the Rental Housing Outlook, and our Master Plan Outlook. Our advisory team is another that focuses on analysis, where our experts provide custom market studies across the country. Besides written reports, our experts are also on the road talking to clients and presenting on the housing market. Make sure you join us to see our speakers and network at one of our upcoming Dealmakers events. You can scan the QR code to learn more. While a lot of our focus is B2B, we are rapidly expanding our reach with B2C. NewHomeSource.com is our direct-to-consumer platform. Through NewHomeSource.com and Zonda's digital solutions, consumers can see 3D renderings and interactive floor plans, and even schedule self-guided home tours. Now, today's webinar would not be possible without our two great sponsors. Our first is Westwood Insurance Agency. Westwood Insurance Agency was founded by a builder in 1952 and has helped over 1 million people protect their homes. In an age where insurance cost and availability are top of mind for consumers, Westwood Insurance Agency can offer your buyers an accurate quote early in the home buying journey, giving them peace of mind and ensuring you close on time. Thank you, Westwood Insurance Agency, for your sponsorship. We also want to thank LiftMaster. You may know the LiftMaster brand for its garage door openers, but they also are a market leader in access control across residential and commercial segments. The Chamberlain Group, the parent company, was acquired by Blackstone in 2021, accelerating their growth. The Chamberlain Group continues to expand their network of partnerships, including Amazon and Walmart. What this means to the housing industry is you have a complete smart home access solution called the MyQ ecosystem. The LiftMaster, powered by MyQ ecosystem, is a full suite of products that combine reliable hardware and MyQ smart technology for complete control and insight over a home's main entry points. Thanks again, LiftMaster and Westwood Insurance Agency, for your support. Now, without further ado, today's presentation will be split into two parts. I'll start with a 15-minute high-level overview on the market before I pass the virtual stage to Dan Fulton, who will do a deep dive on Midwest trends. Now, where I wanted to start today's presentation is with a recap of our thesis for 2025. So many of our subscribers know that once a year we put out our forecasting report laying out what we think is most likely to happen. Here, I'm going to high level provide 4 of the key trends we're watching. The first is more supply. We anticipate seeing more supply across the resale, the new home, and the rental market this year. I'll cover each of those components throughout this presentation. We're also looking for a modest rise in sales. We're looking for about 3 to 5% growth, which maybe sounds a bit aggressive, but remember that if you apply a 3% growth rate to existing home sales that came in at the lowest level since 1995 last year, we're still talking a constrained market. 3, unfortunately, as much as we wanted to believe that interest rates were going to come down, there's just been enough indications that we are now in a higher for longer interest rate environment. So we are anticipating rates holding in those high 6s, low 7s throughout the year. And as a result, number 4, we do think this will be the year of margin compression for home builders. Incentives are very prevalent. We'll talk about those, and also costly later in this presentation. Land costs have either flattened out or continued to go up. And we know that a lot of communities are now working through that legacy land, and they're seeing higher land basis moving forward. And we're keeping a close eye on what happens with deportations and tariffs, both of which could potentially put upward pressure on the labor and material side of things as well. But let's break down some of these trends, starting with the idea of more supply. Now, if you recall, last year we did see more supply compared to the year prior, but what is happening with supply is so localized. This is showing months of supply across the country. The darker the purple, the higher the change from 2019. The actual months of supply is coming in as the parentheses. So what you're finding, and as a reminder, generally 4 to 5 months of supply is considered balanced. We do see in parts of Florida, we're looking at 6, 7, 8 months of supply, putting those markets in buyer's territory. We still have some pretty dominant sellers markets. This includes the West Coast, the Midwest, and the Northeast. You will find in a lot of different data sets today that the cluster will show that the West Coast, the Midwest, and the Northeast are behaving at least somewhat similarly. In these instances, we're looking at months of supply, in some cases under 1, in some cases high 2s. Again, seller's market. And then you can look at some of our high growth areas, high production. This will be Arizona, Texas, where depending on the month, we fall between a seller's market and a balanced market. The December data moved us back towards seller's territory, but in general, we've seen trends that look more conducive to balanced markets. But the reason we need to start our presentation by looking at supply is because we know that there is an inverse relationship between months of supply and new home sales. So as we track out periods of higher months of supply, that does typically correspond with, at least all things considered, lower overall new home sales. Now, that's not exactly what we're seeing play out on the ground today. As we look at new home sales, this is to close out last year, we did see that sales finished 2024 up on a year-over-year basis and higher compared to where we were in 2019. So this is in stark contrast to the existing home market that's really just muddling along, but it doesn't mean that sales on the new home side have been easy, that they've been cheap. In fact, as we talk to builders, they'll say, hey, it takes a lot of marketing dollars. It takes a lot of hand-holding to ultimately get a consumer to go through with purchasing today. And in fact, they need to be a needs-based buyer, not just a discretionary buyer in a lot of instances. So to start the year, we asked builders about what sense they're getting with consumers. And this ties back to the idea that sales are not easy. The top 3 responses we hear from builders is that affordability is by far the biggest issue. We also have consumer confidence and just consumers choosing to sit on the sidelines. Now, there are some positive responses that we heard from the builders. Consumers are open to exploring more housing options, or we're seeing more traffic and sales despite higher rates. But you can see collectively those pale in comparison to the top 3. Now, the one that we're keeping a close eye on, though, is we gave builders the option to say things are looking great for the spring selling season. And we saw fewer than 5% of builders say, yeah, that's the case. And so this then leads us to a discussion of the spring selling season. We know that we have now seen it kick off now that the Super Bowl is behind us. On February 3rd, we released a report to our clients of National Outlook, going through the top trends to watch in 2025. We went through what we covered last year, as well as what we're paying close attention to this year. I'm going to focus on the 3 things that we think we should be paying close attention to throughout the next few months. One is the impact of the rental market on for sale demand. The second will be incentive usage, and again, the accompanying margin compression that comes with that. And 3 is the sustainability of the high-end market. So as I go through the rest of my presentation today, I'm going to focus on these 3 points, starting with the rental market. Now, if you don't know, we have a multifamily expert. Her name is Kimberly Byram. Her and I often talk about, okay, what's happening in for sale, what's happening in for rent, and how are these markets impacting each other? Oftentimes we think about rental and for sale in isolation, and in particular today, you can't do that because there is so much from the rental space that is bleeding into the for sale space. Most notably, this comes down to supply. So this chart is showing you multifamily units completed. Completion would mean they become available to the consumer. So now they have more rental options. In 2024, we saw the highest level of completions going back to the 1970s. And as we forecast out what is likely to happen, we anticipate maybe not peak completion, but we expect completions to remain extremely elevated throughout 2025. Put a different way, we came from an environment where people did not have options. And now all of a sudden, depending on where they live, they're finding that there's more rental units available, there's more for sale homes available, and that's leading to more optionality. Now, if you look at completions and you think about how many units are getting delivered and you say, okay, well, how are they also being absorbed? This is an important way to look at it because we're tracking out occupancy at rental communities across the country. Remember, I said you would find this regional cluster in different data sets. So in the West Coast, in the Midwest, in the Northeast, we find that overall occupancies are high, which means we're not finding that landlords are having to drop rents or they're having to offer too aggressive of concessions because they have pretty reasonable demand. When you look at the high growth Sunbelt markets, though, this is the part of the country where we have seen a lot of supply hit in a short period of time. On a year-over-year basis, we've seen in some instances rents have gone down, and in a lot of these markets, we've seen concessions go up. Concessions mean, hey, you can rent here and we'll give you a month or we'll give you 6 weeks for free off your rent. That understanding the rental space is important because now all of a sudden, if you have someone that wants to convert from renting to owning, they're saying, all right, well, right now I can get 6 weeks free and rents have gone down and interest rates are not coming down on the for sale side. So affordability is really telling me it makes sense for me to continue to rent. When you track that out with what we're seeing in for sale data, it really shows a trend that makes sense. This is our Zonda market ranking, our ZMR. This is available to our Zonda National Outlook clients, where we say, okay, what has happened with sales? What has happened with supply across the country? And then we can quantitatively assign a ranking. What we find is that the entry-level market today in the for sale side is the slowest by a long shot. 42% of the top markets are overperforming. 42% of the top markets are underperforming. And I think this ties back to affordability and optionality. Now, builders, they can respond to concessions with incentives. And we know that incentives are prevalent across the housing market today. We have 60% of projects that have to-be-built homes that are offering incentives. That will be a lot that you can pick your lot, you can pick your finishes, that falls into to-be-built. We have 75% of all projects that are offering incentives on quick move-ins. A quick move-in is a home that can be moved into within 90 days. Generally speaking, builders have offered more quick move-ins as a strategic move, but they don't want to sit on those quick move-ins for too long. So that's why you are finding that higher use of incentives with quick move-ins. But again, look at the regional breakout. You will find it's the higher growth where you've seen more migration and you've seen more building where you are finding the highest use of incentives. So spread across the Sun Belt, most notably in Florida, where we have some markets, 95% of all projects today are offering incentives. Now, incentives are interesting because they come with, I'd say, two major headwinds right now. The first is that incentives have lost their effectiveness. So consumers used to be driven by incentives, and now consumers expect incentives to be there. And just because an incentive is there doesn't mean they're going to rush to purchase. They feel like because they're so prevalent, they can take their time. But I'd say more importantly, incentives are expensive. When you look at the kind of incentives that builders are offering today, they are offering still the same things we've seen: mortgage rate buydowns, funds towards closing costs, flex dollars. But right now, those mortgage rate buydowns that as of January, builders are willing and able to do will get the interest rate from high sixes, low seven to high fours, high fives. So this is very expensive from a builder point of view to buy down this rate so dramatically, but incentives have also been a reason why the move-up market has held up relatively well on the new home space. If you have someone that is locked into 3% interest rate, which we know is a huge part of homeowners today, resetting the interest rate from 3% to 7% market rate is challenging. That's a huge monthly change. If you have to reset your interest rate from 3% to 5% because the builder's offering a 5% buy down, that all of a sudden at least makes the math make a little bit more sense. So like I said, we've seen that the move up market has been able to perform relatively well on the new home side, same as high end. So again, this is what you saw before when I showed you the Zonda market ranking for entry level. Now you're looking at the Zonda market ranking for high end. And what you will notice is there's far fewer red dots. You have more of a mix of some markets that are overperforming, some that are average, some that are slightly underperforming. But specifically take a look at the Midwest, our focus here today. You can see the high-end market, generally speaking, is overperforming in most markets. Now, this then leads me to the third key thing that we're watching for the spring selling season is how resilient and for how long are we going to see that strength in that high-end market? Now, we do feel good about the high-end market. We released, and if you go to Builder Online today, you can find our full article. We released our top 10 markets that we want to watch for this year. Our focus was on the high-end market because high-end market buyers have shown less sensitivity to rising interest rates or rising home prices. Oftentimes, they can be a bit more of a discretionary buyer, or they can tap wealth that allows them to still be active. To come up with this list, we included almost 10 inputs looking at job growth, looking at income taxes, looking at home price appreciation and homeowners insurance. But again, it's fairly similar to the distribution. You see some West Coast, you see Indianapolis in the Midwest, Boston in the Northeast, and then some of the Carolinas, where there has been a lot of migration, a lot of people coming from with equity that still allows them to be active in the high-end market. Our question here and the risk here is a lot of our forecasts assume that the high-end buyer stays active throughout this year, at least to a similar extent we saw last year. We're just tracking for how these consumers take in new uncertainty that's happening with the Federal Reserve, with policy, higher for longer interest rates, with the new administration, just a lot of things that consumers need to juggle and make sense of right now. Now, ultimately, if we roll all of this up, we like to ask ourselves, well, where do we go from here? We have a sense that there's some positives and some negatives in the market, but we want to be thinking about housing starts. To be able to forecast housing starts, I don't know how any organization can do it without having access to land and lot data. Land and lot is the basis for new construction. We just released our fourth quarter data that shows vacant developed lots that could go vertical tomorrow, have come in at the highest level we've seen since the start of the pandemic. Now, the purple bar is telling you absolute VDL inventory. The blue line is telling you months of supply. And what we're finding is the months of supply is coming in at 20, which is the same as 2019, which puts us at equilibrium level. So while we do have more VDLs, we also have higher starts, and that's why that months of supply is coming in back to where we were in 2019. Now, for us, tracking out not only vacant developed lots, but also the lots that we have under development. Keep an eye out. Tomorrow, we're posting our lot supply index, but both of those stats support our forecast of seeing single-family housing starts rise 2.5% this year versus last year. Now, there are certainly a lot of reasons that we could be overstating growth if the entry-level market continues to be hit by the resale market, if we continue, the rental market, if we see affordability just pushes consumers to the sidelines, if we see any broader shifts. Of course, 2.5% will be too high because consumers need to be buying homes for builders to feel comfortable to be starting new homes. But as we think about 2025, lots of trends that we're keeping an eye on. New administration is another risk to our forecast. So we know the Trump administration is pro-growth, less regulation. We're here for it. We love that. We want to see more growth. We want to see less red tape. But if you do think about some of the policies, things like tariffs, deportations, higher for longer interest rates, those do disproportionately negatively impact our industry. We know that there's a rising cost, not only to buy a home, but also to hold a home. There's been so much discussion about how if you own a home, you don't have to be worried because you fixed the largest share of your monthly budget. Yeah, you have, but we know that HOA costs are going up. We know that in some states, Property taxes are resetting at higher values. That's coming at a shock to existing homeowners, especially when combined with rising homeowners insurance. So we're keeping a close eye on the top markets. We flagged a long time ago that we've seen a little bit of cracks starting to show up in parts of Texas and Florida. Texas and Florida collectively represent 40% of our top 25 production markets in the nation. So put a different way, what happens in Texas and Florida is critically important for what happens with total housing starts for the year. So again, if we see more challenges in these top markets, it's another reason why our starts forecast could be overstating growth. We're keeping an eye on that supply and demand. Where is the right level? Remember the two regional differences, the Sun Belt really versus everywhere else. Sun Belt has seen rising resale supply, rising new home supply, rising build to rent supply, rising supply in the rental side. We want to watch that. We know that demand is up because of migration, because of employment, but we got to find what that equilibrium is. And ultimately, we're tracking affordability. And because today's focus is on the Midwest, I just want to make a statement there, which is we know that the Midwest relative to itself has gotten very expensive. And Dan's going to show some stats on that. I grew up in Cleveland, Ohio. Cleveland prices today look nothing like where they were even just 5 years ago. But if you look at the Midwest on a national landscape, and you have people that are still working from home and saying, where are there still affordable options, in particular, good bang for buck? I also think the affordability challenges elsewhere in the nation are positive for the Midwest region. So with that, I'd like to introduce Dan Fulton, Zonda's Senior Vice President of Advisory and Midwest and Northeast expert. Dan has over 30 years of experience working for various home builders as well as a consultant. Personally, Dan and I have worked on and off together for the past 10 years, and I've always heavily relied on his insights and expertise when trying to make sense of the market. So Dan, let me turn it to you.
Hey, thank you, Allie. I appreciate it, and I just absolutely love hearing your take on the market and how you present things. It's really just a very informative presentation. I appreciate that. So today we're going to be talking about the Midwest, specifically three markets: the Chicago market, Indianapolis, and Columbus. Which I learned during this presentation preparation that they're about equidistant from the city center from each between Indianapolis and Chicago and Indianapolis to Columbus. So just consider that some useless trivia, as you move forward in your planning. But today's presentation is going to be talking about the economic drivers. What's driving housing demand in each of these markets? How healthy is the market today? And what does that new home market supply and demand situation look like? So let's start with Chicago, just talking about what's driving Chicago. Chicago is a fascinating, metropolitan area with 35 of the Fortune 500 companies headquartered there. You can see with the selection of the companies represented below, you have major corporations, you have agribusiness, you have financial, you have corporate manufacturing businesses, all headquartered in this town of Chicago. So what's driving it today? Some of the things we're looking at are the return to office trends. So you're seeing, and I've read recently that Chicago is seeing a significant trend of bringing a lot of companies headquartered there, bringing a lot of people back into the office, and so that's going to be important for communities that are located closer to employment centers. And it's going to be less, it's probably going to impact those communities on the perimeter and those submarkets on the perimeter of Chicago that have enjoyed that work from anywhere trend that we've had over the last 4 or 5 years. So that's one of the trends we're looking at. We are seeing some corporations leave Chicago due largely to rising taxes and some of the higher crime rates. Now, they may be leaving city centers and moving out to the suburbs, or some may be leaving Chicago altogether, such as Boeing left headquarters, left Chicago, moved to Arlington, Virginia. And another thing we're seeing about is more just a economic cyclical trend. ADM, a major corporation in Chicago, is starting to slow down their hiring. They're starting to slow down their expansion plans, as they're seeing demand for plant-based products start to slow. Now, seems like a very specific item to pull out here, but I think that's in an agribusiness type of economy that you find in Chicago, Indianapolis, and Columbus, and throughout the Midwest. That type of trend will slow hiring, and as we all know, hiring is the heart of housing demand. So that's a quick take on Chicago. How about Indianapolis? Indianapolis is a fascinating place. I've spent a lot of time there recently, and one of the things I'd like to point out, Ali, is that high-end buyer, you have that as an overperforming buying segment in Indianapolis and a town to watch. I saw that firsthand just recently, and we're seeing just a ton of high-end communities introduced, all doing well, sustaining strong sales paces, and there's quite a bit of segmentation, which means the affluence of the buyer in Indianapolis is strong. So when you have affluence, you have the opportunity to introduce various product segments. So one of the things I'm looking at closely in the impact on the marketplace is the LEAP Research District and Innovation District. It's a major economic development initiative in Lebanon, Indiana, that is just between Purdue and downtown Indianapolis, and they're bringing what they are marketing as Silicon Heartland to the market, where it's a high-tech innovation district. Eli Lilly just committed to a $4.5 million investment to launch Lilly Medicine Foundry within the LEAP district. So that's a big, big deal, and it's going to draw a lot of housing demand and present builders and developers a lot of opportunities in that marketplace. North of town, also in that affluent Hamilton County area, that Grand Sports Park Sports Campus is becoming more than just a travel sports mecca. It is becoming a business district, and that again is going to bring housing demand north of the town and create again that segmentation opportunity. And one of the things I've learned about during my business in Indiana and Indianapolis is that it's a major destination for relocating home buyers from the two coasts, from West Coast, East Coast. These high price markets are pushing people out, and there's the new home developers and builders in Indianapolis are seeing a lot of relocation. To the extent I asked every salesman I spoke with the other day, about 10 of them, they said 25 to 35% of their buyers are relocating from the one of the two coasts. So I think that's a pretty significant number. And taking a look at Columbus. So interestingly, Columbus is a new market for Zonda. We just introduced the Zonda enterprise system there with our methodology. So I always enjoy digging into the data here and understanding the market. So the economic drivers for Columbus, one thing I'm looking at closely is Intel. They're planning to invest $28 billion in the construction of two leading edge chip factories in the New Albany submarket just outside of Columbus. That's a major, major investment and jobs driver. So that will drive a lot of jobs and housing demand to that area just east of Columbus. NIH, so part of the federal changes that we've seen recently, the disruption that we've seen, the NIH is cutting funding. So this to many of the research facilities around the country. And this is going to impact housing demand locally in a localized fashion. Markets that are influenced by Ohio State Medical and Nationwide Children's Hospital. Those are two major recipients in the Columbus area of NIH funding. They will likely see some type of job losses in that area. So we'll take a look at that closely as we look at developments that are near those entities. And then relatively small investment, but because it's a $1 billion investment, spread over 3 different market areas. But Honda is shoring up their facilities to support EV capabilities. Locally near Columbus, Marysville, Ohio, will be the benefit of that investment. So, but overall, Columbus is a diversified market area driven largely by Ohio State. It's the economic engine of the market area. Ohio Health is medical, JP Morgan, Cardinal Health, Nationwide Insurance, and Honda all have major presence in Columbus, Ohio. So as we've talked about, jobs are the driver of housing demand in a market area. So what we're looking at now, and I'm presenting to you is the annual employment change by metro area. Which markets are growing fastest? Chicago, well, let's take a look at Indianapolis and Columbus, which are 2 of the smallest markets in this set, are growing the fastest. And I'm comparing the 3 subject markets today, the Chicago, Indianapolis, and Columbus, to 4 relatively mature markets, Washington, Philadelphia, New York, and Baltimore. And we'll be looking at that comparison for the next few slides. But Indianapolis and Columbus are coming in strong with 1.5, 1.3% annual employment change. If you look at that compared to Chicago at 0.5, it's lagging a bit, and the next few slides will tell you why. Washington's coming in pretty strong, but Chicago is acting very similar to the other mature markets in this competitive set. So in terms of unemployment rate, Chicago, again, a little bit lagging. It's coming in at a higher unemployment rate, but it's only 4.5%, and that's relatively strong historically. The other markets, 3.3%, 3.4%. I mean, that's essentially full employment. So the employment situation in the region is strong of the 3 market areas. But it's high wage jobs that drive new home demand, especially so in more affluent, higher priced market areas. What I'm showing you here today are the 3 sectors: the professional business services, finance, and information sectors. These are categorized by Zonda as high wage employment sectors. And these are the 3 sectors that we look at closely when we look at the strength of the housing demand in a market area. But what I wanted to show you here today is that the professional business services, these are essentially office using jobs. This is the dominant sector in these market areas. Chicago, Washington, and New York have the largest markets for professional business services. But in Indianapolis and Columbus, it's the largest sector of the 3 that I'm presenting here today. But what we're going to look at next is the change. And this is what's important here, the change in the high wage job sectors. So Chicago has seen nearly a 4% decline in the number of professional and business services jobs. And this is a year-over-year decline. Indianapolis has been strong with professional business services, which is the dominant sector, and we'll focus on that here today, with a 1% increase, whereas Columbus has actually seen a decline, over maybe 1.5% decline in the number of professional services jobs. Most markets that we've looked at on the East Coast are also seeing a decline in the professional business services. The information sector, for your information, is largely technology oriented, bringing information to market, and that includes data services, et cetera. So it's a little bit complicated, so we won't go into it in depth, but that's essentially what we're looking at. So let's take a look now. We looked at jobs. How are home values appreciating in the Midwest compared to other markets? You can see and the data we're looking at here today is the FHFA, which are the enterprises for Fannie Mae, Freddie Mac. Their annual the home price index, and we're calculating the annual home value appreciation over a 10-year period. So again, looking at all the comparison markets on the East Coast compared in the Midwestern markets that we're studying here today, we can see that we've reached peaks in Philadelphia and Indianapolis. Roughly, we've reached 18% appreciation year over year, but that was in 2022. And but that declined, but it didn't go negative. We haven't seen a negative year-over-year appreciation over the last 10 years. Today, we're seeing in the Chicago, Indianapolis, and Columbus markets roughly 4 to 6% appreciation, 4 to 7.2 actually percent appreciation in 24, which is up from 23. Let's take a look at the resale housing market conditions. Days on market. This is the velocity. How long does it take to sell a home? So essentially, what we're looking at is, oops, sorry about that. Let me go back up. Is stability in year over year in Columbus. We're slightly lower number of days on market in Chicago, and slightly lower in Indianapolis, as well as supply remains tight. So it's relatively strong number. We're looking about 60 days in Chicago, 50 days in 50 days in Columbus, and 30 days in Indianapolis. So overall, I mean, it's a little bit high in Chicago, but that's it's not out of the ordinary. And same with Columbus and Indianapolis. So we look closely as I look at markets and the health of markets. How are resales selling on a price-wise compared to their list price? And when it's lower than 100, that essentially tells you that that sellers are coming down in price to sell their home. So it's more of a buyer's market. And all three markets that we're studying here today have lower average sale to list price at the end of 24, which is essentially roughly the same point at which we were 1 year ago. Median sales prices are up year over year in all three markets and nationally. So as supply is constrained, prices have risen. This is the price of homes being sold today, not necessarily the appreciation or the actual value of homes themselves, but this is the median sales price of all homes sold in each market. And so when we look at months of supply or the inventory of homes for sale, overall, they decreased year over year as sales increased and the inventory or the number of active listings tightened. Currently, the market is roughly at two months, plus or minus, depending on the market, while a 4-month supply is what we would consider to be a healthy market. Let's take a look at the region's newest top performing projects. So we're moving from the resale market to the new home market. And what I wanted to show you here today is our communities that have opened since January 24 and are the top selling community of that set by product type, single family or detached or attached. So let's call out Riverstone in the Chicago metro area, Riverstone by MI Homes. This is a community of really pretty beautifully done single family detached homes priced in the 540s. They're selling 10.5 sales a month. Townhomes in the same community, 7.3 sales per month. That's a strong community. I've spent some time in Plainfield recently, and I tell you what, it's a incredibly active development market and so impressive and really just strong selection of housing. Looking north in DuPage County, the Wonder Lake submarket, you have Lexington Homes offering Metro on Main, with townhomes averaging 583 base price, selling 7.2 units per month. So that's a strong performance by a local privately held home builder. In the Indianapolis market, you have Sapphire Ridge by Lennar, averaging $439,000, 6.3 sales per month for Lennar. That's probably a pretty typical Lennar sales pace overall, if they're looking at a quick move-in strategy for their communities. And Lancaster by Lennar in the Westfield submarket of in Hamilton County. Duplexes selling for a very low price of $289, 6.8 sales per month. I was recently in this community, and really is well done. And the product is well spec'd out, and and this is in, I have to say, a very competitive housing market. So in the Columbus submarket, Burkeview by D.R. Horton. It's in the Canal Winchester submarket of Franklin County. Single-family detached homes from 401, selling 4.6 sales per month. And then you have Terra Alta Towns by Ryan Homes in the Delaware submarket of Delaware County. Townhomes, again, 326,000 average base price, 5.2 sales per month overall. So it's really strong performance. So it gives you a sense of the value in unique selling propositions for each of these market areas. So in the new home market, let's take a look at the activity here. First of all, let's look at overall supply of storefronts, the number of actively selling projects per community. In the Chicago metro area, you have 268 projects today, with about a quarter of those, maybe 20%, being attached. This selection of communities represents a 43% drop from 2018 peak. So it's in my experience on the East Coast, many of our competitive markets on the East Coast have seen drops of 60, 70%. And so a 43% drop, while that seems like it might be significant, it's not as significant as other market areas. In the Indianapolis metropolitan area, you have 234 actively selling communities, which represents a 29% drop from the 2018 peak. Not horrible, but still, it's a significant drop. What I'd like to point out for Indianapolis, Columbus, is the actively and the growing share of attached units for sale. Columbus, you have 168 actively selling projects, down 28% from the May 2020 peak. Again, you're seeing a very small percentage, a mix of attached units, but it seems to be growing as perhaps townhomes and villas become more popular there. How about overall volume? What we're looking at is the actual volume of permits issued by year for each of these metropolitan areas. Chicago, 9,600, almost 9,700 permits issued over the last year, compared to 8,700 for for Indianapolis, and 5,700 for Columbus. I'd like to point out how strong the performance is for Indianapolis in a growing metropolitan area relative to a mature metropolitan area of Chicago, where Chicago's stronger today, but if you look at 21, it was roughly selling the same volume of homes from a much smaller metropolitan area. And another comparison I'd like to point out is Indianapolis and Columbus are relatively the same size metropolitan areas. In Columbus, it sells a significantly smaller share of new homes relative to the overall population. So builder competition in these markets is pretty consolidated. In each of these metropolitan areas, you're seeing 88 to 91% of the market captured by the top 10 builders. So who are those top 10 builders? In Chicago, Lennar captures 25% of the starts overall. And then you have D.R. Horton and Pulte, all big name public home builders. Lennar in Indianapolis as well captures almost a third of the starts in Indianapolis compared to the next highest, Pulte Homes, which has 12% of the starts. So dominant share of the marketplace by Lennar. And looking at Columbus, MI Homes leads the way in Columbus. It's their headquarter location with 22%, nearly one quarter of all home sales are built by MI Homes, all new home sales, followed by Pulte. Pulte is strong in each of these three market areas, as is Ryan and D.R. Horton. And they're located in all of these market areas. So again, 88%, 91% of all home sales and new home sales in these market areas are captured by the top 10 builders. So sales velocity has dropped recently as mortgage rates have risen and the economic conditions have become more challenging. Indianapolis has declined from 3 sales a month in early 24 to 2.4 sales a month, but it's still leading the way. Columbus has declined from 2.5 sales a month to 1.9 sales per month. And Chicago has declined from roughly just over 2 a month to 1.6 sales per month. So when you have to look at these absorption numbers relative to the history, not necessarily you wouldn't apply these to the specific community. Many of our public home builder communities would be underwriting 3, 4, 5 sales a month in specific submarkets, but this is a blended average of all activity in the submarket. Prices have risen since 2020, but have stabilized recently. If you look at the difference in pricing from Chicago to Columbus to Indianapolis, Columbus is a much more expensive market than you'll find in Indianapolis, and it's inching closer to the median average base price of homes in Chicago. So Chicago has dropped slightly. If you look at the 2024 numbers over here, dropped 1% in the average base price, whereas Indianapolis has increased. And Columbus has seen a 4% rise in average base price year over year. But it doesn't really compare to 22 and 2021 price increases, which were significant. But so you can see the market slowing, but it's in line with what we saw in 23 as well. QMIs, as Ali mentioned earlier, are a way for builders to satisfy that the resale buyer perhaps that wants to move quickly but can't find a resale home that fits their needs. It's many builders have this just as a specific strategy that all of their homes are quick move-ins. So it's interesting to keep track of as this tells you the builder's confidence in the marketplace. As there's more quick move-in homes in the marketplace, builders are more confident that the market is strong and will sustain that excess inventory. When the quick move-in inventory declines, that's when we see builders becoming a little bit more concerned in the marketplace. So it's somewhat of a barometer of the health of the market. In Chicago, which is the light blue, what we're looking at is the months of supply of quick move-in homes on the marketplace. Chicago has declined from 3.5 months of supply to just under 3. So it has seen a slight decline, but not significant. Indianapolis in purple has roughly 1.5 months of supply, down from almost 3 months of supply in mid 2023. Columbus is coming in just a tad higher at roughly 2 months of supply. So all three markets are, relatively close together in terms of months of supply, and it's not too different from the historical average of all of these. Vacant developed lots, in the supply of vacant developed lots by market areas is something we track closely. Chicago in the blue has historically had a huge number of vacant developed lots that on the marketplace due to overbuilding and overdevelopment in earlier years. So the market, and you'll see a later slide that shows the market has significantly cut into that oversupply and is operating pretty efficiently today. We'd like to see that number get down under 30 for Chicago, and we'd like to see the Indianapolis and Columbus numbers get above 20 to become more of a healthier ecosystem of developments, lot supply and demand. This is what I was mentioning earlier, the huge number. If you look at the purple columns, that is the lot supply, the number of vacant developed lots on the market today. The light blue are the annual starts, and the starts chew up the vacant developed lot. And the yellow markers are the calculation of lots divided by starts. So again, we'd like to see that yellow marker right here, roughly 32 months of supply, get down to under 30, preferably around that 25 level. So one of the things that contributes to that vacant developed lot inventory are the inactive communities out there, and it's interesting that you have all of these 7,800 lots in communities that have not seen any building activity over the last year. So these are scattered throughout the Chicago area. I spot checked a few of these, and they're actual communities out there, and with lots that are available. So it's to me, if I were a land guy in the marketplace today, I would look closely at these developments. Indianapolis, again, the vacant developed lot supply is relatively strong, just under 20 months, which is okay. We'd like to see that above 20. But you can see that the purple line, which indicates the vacant developed lot activity, has increased along with the starts activity. So that is a positive trend that we're seeing. And you're starting to see the vacant developed lots increase over time, the months of supply. Again, similar to Chicago, the inactive developments that have vacant developed lots within the communities are scattered throughout the metropolitan area, with Noblesville over 50 lots in this community, and you can see the darker the shade of green, the more the lots. So significant opportunity here. It takes a little time to get through these and dig into each of the developments, but I think there's opportunity here. And in Columbus, a new market, again, similar numbers. We're only tracking Columbus back to 2023 today, and the numbers are still pretty raw, but we're looking at roughly 17 months of supply. And as far as inactive lots, we're starting to see a couple of these developments around the town with a pretty significant number of VDLs that do not have any starts. So let's wrap this up. So the outlook, what are we looking for the next few months through 25? First of all, and Ali mentioned it earlier, the Midwest, we expect to outperform the national housing market in the number of starts. So all three markets presented here today have posted impressive gains in 24 in the number of permits and starts issued. So we're applying that number, that improvement, and we think that much of that momentum will continue into 25 as resale inventories are remaining tight. And we expect that tight inventory to lead to greater new home capture. Many markets, what we're seeing today is roughly 30% of new home sales or of all sales go to the new home market. That's an increase from about 20% in previous years when there has been a resale market that's at equilibrium. Pricing power has peaked, and we believe that we'll probably see some pricing pressure, some pressure to reduce prices or increase incentives as we move forward. And the federal disruption, this is in the Midwest going to be more of a localized situation. But I feel that the tariffs, the change to federal employment, federal funding, it's what we mentioned with the NIH funding earlier, and these new policies that are coming out will permeate the overall economy, meaning we might see some economic pressure, but we expect to have major impact on specific submarkets that are affected. For instance, if you have a heavy influence of federal employees in a submarket, you might see less housing demand, or you might see, or if they're subject to federal funding or the recipient of federal funding, you'll see perhaps less housing demand. So moving forward, again, we have seen significant improvement in starts activity for 24 compared to 23. This table in the top left, you're looking at 11%, 26%, 10% increase in the number of starts. We're using permits for Columbus. And I'm applying that to the forecast for 25 and 26. Roughly 10% increase in the number of starts or activity for Chicago and Indianapolis. And then Columbus, we're expecting a 5% increase in the number of permits, and then a 5% increase for 26 as well. So you can see what we demonstrate here is the number of starts moving forward or since 21. We've dipped as the market has sustained higher interest rates in a more of a struggling economy, but we've improved over the years in these three market areas, and I expect that to continue overall. So, so that's our forecast for the next year, and I'd like to thank our sponsors today, LiftMaster and Westwood Insurance Agencies. Thank you so much for sponsoring this event. And for everybody else, I'd like to invite you to go to ZondaHome.com and sign up for the events. Zonda has the premier events in the marketplace, and visit ZondaHome.com to register. Thank you very much.